What I find particularly interesting that there is a large number of patterns of price actions that people use to argue that we're actually in mid-cycle, that the economy is strong, but all of those things have been present at the end of the last two cycles. I will start with one which was particularly interesting and decisive, is the price action on oil. What we currently have, oil made a low, a very significant low a couple of years ago, and that's been running very strong. And many people argue it as an argument for inflation or indication of strong global growth. But if you look at the previous two cycles, oil did exactly the same thing. It made a low, a local low 1 or 2 years before the recession arrived, and was strongly running up right into recession. It is actually a very, very distinctive pattern. By itself, and here, just as with everything else I will say further, the rise of oil price itself is not an indicator of recession coming. Very often it goes up and the recession does not come. But it is consistent with late cycle. Like current price action on oil is consistent with late cycle. So what are other things that what are consistent with late cycle? One of them is the arrival of stock market volatility. And what is interesting is that when this volatility arrives, like it did in January of this year, end of January of this year, or it arrived in March 2000, or it arrived in July and August of 2007, neither of those actually marked the absolute top of the stock market. For example, NASDAQ even this year made another high recently, I think in March. Similar, the stock market highs were actually December 2007, much closer to actual recession. So this arrival volatility, but not the top, is very consistent of late cycle. And also divergent performance. This might be a little too technical, but divergent performance between various stock indices. In 2000, there was a period when NASDAQ started to sharply outperform Dow, and then it sharply underperformed. And we had this on a smaller scale, this type of price action this year as well. In fact, arrival of strong earnings and unambiguously strong economic numbers is also consistent with late cycle. This all happened in other cycles. The arrival of very strong inflation concerns that people claim was an argument that rates will continue to go up, like the very low unemployment, strong job growth, growth in average hourly earnings. All this stuff actually, which people see as an indication to higher rates, in the past led to much lower rates because that marked the end of the cycle in the past. Particularly interesting it is to observe the pattern in bonds. What I look at is, as always, as roll-adjusted classical bond futures, the long total return chart. Both of them had protracted backup. So in both previous cycles, there was a protracted backup in bonds, not just a sharp. There are many bond corrections over the last 25 years, probably at least 9. And most of them are sharp corrections with sharp recovery. Towards the end of the cycle, it was more of a protracted correction, often with double bottom, like recently, for example, in our market. And that is usually a precursor for huge rally in the bonds.